Do you want to learn how to analyze a stock in just 5 minutes? Today, using Amazon as our example, I'm going to show you exactly what I look at when researching a company before I invest a single dollar. First, head over to the browser and select that stock that you want to research. When you open the stocks page, the first thing you're going to notice is a snapshot of the key metrics. This is designed to give you an overview of how the business is performing. You're going to notice as well that a lot of these metrics are shown across 3 time horizons. The first is next financial year, which is based on high quality consensus estimates from IBS, the Institutional Brokers Estimate System, which aggregates forecasts from professional analysts. Then we have trailing 12 months or TTM. It reflects the most recent 12 months of actual performance, making it more current and more informative than the last reported fiscal year. Then we have the 3-year average, which provides a longer-term context and helps you compare the latest performance to a more normalized multi-year trend. So by presenting forward estimates, the most up-to-date actual results, and a normalized historical baseline, you get a balanced and transparent picture and not just a single backward-looking number. Now, when checking these metrics for Amazon, there are 2 things that stand out to me. First, Amazon is expected to grow sales in the double digits. For a company this massive, bringing in nearly $750 billion, that is exceptional. Then, the operating margin has jumped to 12% compared to the 9.7% average over the last 3 years. And this improvement flows down to a key metric called Return on Invested Capital, or ROIC. ROIC is currently at 20%. It means that for every dollar Amazon invests back into the business, it gets 20 cents in profit. That is a sign of a very efficient and strong business. If you scroll over any of the metrics, the platform will show you how they are calculated, as well as how they rank against other companies. For example, Amazon's ROIC is in the 85th percentile, meaning it sits in the top 15% of all companies. StockTrader.studio takes these rankings one step further by giving each of these stocks a score in terms of profitability and growth, and it also provides a valuation score based on a discounted earnings exercise, which we're going to get to in a minute. This scoring system is designed to help you quickly identify those very best ideas for your portfolio. Now below that, let's take a look at the price chart. I always like to see if the stock has recently gone up or down, and here we can see that Amazon has taken a little bit of a hit over the past few months. So using the overlays feature, I can track how the stock price has moved against its earnings or even against the platform's own valuation. In this case, the decline does not seem to match the earnings trend. And that tells me there could be more to the story than what we've seen so far. But this is exactly where the platform's AI tool Charlie becomes incredibly useful, because instead of reading through pages of earnings reports, I can let Charlie summarize the latest developments straight from management's commentary. The color coding also makes it easy for me to spot risks versus opportunities. From the summary, I gather that Amazon has recently increased spending in AI-related infrastructure, and while this is great for the future, it seems to have ignited fears among investors about the returns in the short to medium term. So the financial history section will help me connect these short-term concerns with the long-term fundamentals. The good is that revenues are still expected to reach $1 trillion by 2028, and this growth is probably helping the company dilute its fixed costs, which is why we're seeing operating margins that have been expanding from the mid-single digits that we saw a few years ago to the expected teens over the next 3 years. However, it is growth that is coming at a price, and as Charlie mentioned, CapEx or investments in the business have surged, and this has crushed free cash flow. Free cash flow is the cash remaining after the company has paid for expenses, interest, taxes, and long-term investments. Warren Buffett tends to focus on this because it shows how much actual cash the business generates. Right now, Amazon is spending heavily, which is squeezing that number. Finally, we get to valuation. I always like to look at the price to earnings multiple and compare it to its own history. Currently, Amazon's PE is below its 3-year average, but for a high growth company, a falling PE often just means earnings may be catching up to the stock price. It does not always mean the stock is cheap. So to find the real value, we're going to use the discounted earnings method. Traditionally, doing this or doing a DCF can be time consuming, but the platform has a built-in tool that makes it super simple. The integrated tool takes 4 things into account. 1. Wall Street's EPS estimates for the next 2 years. 2. a long-term growth rate of 10 years, 3, a PE exit multiple, which tries to tell what investors may pay for the stock in the future, and then 4th, a discount rate to account for risk. Now, Charlie is designed to keep assumptions quite conservative here, so you can feel free to play around with the inputs based on your own assumptions and your own risk tolerance, but for now we're going to leave them as is. And based on these assumptions, you can see that the model suggests that Amazon is currently undervalued, and there you can see by how much. So what do you think? Do you think that the recent underperformance represents an opportunity to buy? If you want more tips to guide you through your investment journey, make sure you subscribe, and remember, you can always ask Charlie questions in the box at the bottom right to find the top performing ideas for your portfolio. Happy trading!